Hey, what's going on YouTube? Welcome back to my investing channel. As usual, I'm your host Calvin, and today we're going to talk about a couple of exciting topics. We're going to go into detail about implied volatility and what is the implied volatility crush and how to avoid getting this crush when you're playing with options, especially during earnings season. So implied volatility is just a way that markets price the it's an algorithm that is used to sort of price contracts. The higher the implied volatility, the more expensive the contract. So then the implied volatility crush is basically when there's a high implied volatility or a high expected move with in a given ticker leading up to a catalyst event. Typically, you see higher implied volatility come in during earnings, and then during other special events such as NIO's Battery Day, Tesla's Battery Day, a big conference, something that's pending, a large announcement or a date that's they're gonna have a large announcement. With that being said, typically you see a huge drop in implied volatility after earnings, and if you buy a call that is out of the money, there is a good chance that you have experienced this implied volatility crush because the ticker might not have moved enough. So today we're going to be taking a quick peek at what those are and how to avoid it. So before I go into the IV crush, I would like to note that I am not a financial advisor or an expert. Please consult with one before investing. And if you like this video, please show your support. Scroll down, smash the subscribe button. I appreciate your support and definitely love making these videos. So to give you an example of what an implied volatility crush could look like is, say you have a stock such as Uber. Uber fell about $3 in the aftermarket trading after releasing its earnings report. So taking a look at Uber's options, a $64 call was trading around $2.28. You can see there's implied volatility of 142%. Tomorrow morning, as the market opened, this number should be significantly lower. I believe it's going to be around 30%. You should also see this call drop dramatically in value, and that is known as the IV crush. As this number, the implied volatility, decreases dramatically, the value of this option also decreases dramatically. And that is in part because the catalyst event has already passed and the underlying stock did not move as planned. So this $2.28 option, or $228, is going to probably be worth under $25 at the market open. And remember, this is again due to the implied volatility crush. So let's go back here to take a little look. Going into earnings, the market will price in an implied move for the underlying. As earnings approach, the market will constantly price the options to that implied move, which will pump the IV. And right after the earnings event occurs, this volatility will just fall off a cliff, and you're going to see a lot of options get burned. So when you're thinking about playing earnings, when you're thinking about betting on earnings, I strongly recommend that you guys do not go with options. For a lot of new traders, it might seem enticing because there is a lot of gain for certain earnings, but if you're starting out, I would definitely stay away from options for earnings because you don't want to get hit with this crush. With that being said, it's not a bad idea to play earnings. If you're confident in a stock, you think it has done a really good job and that the earnings are going to blow people away, what you can do is you can buy shares of that ticker. I would definitely recommend playing with shares or a credit call spread, or a debit call spread, excuse me, not credit call, but debit call spread. Both are methods that you can use to really improve your chances of coming out with profit versus putting yourself in a position to be losing money unless the ticker moves a lot. You don't want to be caught in a situation where an IV crush wipes away 90-95% of your call in a matter of 10 minutes after the open because of the IV drop. So to give you an example, we're going to look at Pinterest last week. So I traded Pinterest calls last week. I didn't sell, but I wrote those calls. So let's see, I wrote February 12th, I wrote the $90 call right here. Let's see, so you could see, right, this option was priced at about $258 in the 5-day. Let's see if I can get the 5-day, the 1 month. Okay, so right here it was at $294, right? This was right before Pinterest earnings. At market close that day, Pinterest released the earnings, and at that time Pinterest was trading at about $72, $73. Not bad. It's still $17 out of the money with about 6 to 8 days to go. Well, after releasing earnings, you can see that this call opened up at 78 cents, which was significantly lower than what Pinterest or than what it closed on. Even though Pinterest ran from $73 to about $84, $85. So Pinterest moved up $12, $13, but the premium and the value of this contract went the opposite way. It decreased by almost 60% or more. And this is what happens when you see an IV crush. The implied volatility destroys the value of your option, and this drop after earnings on this given call is a great example why you probably want to stay away from playing out of the money calls on earnings season. You might want to stick to maybe shares or something a little safer. So I definitely suggest shares or doing a debit spread. So that's what you have, it, guys. This is the IV crush. Something you should definitely be aware of when you're buying options leading up to a catalyst. I definitely don't recommend a lot of new traders to be buying options and trying to play earnings. It's definitely a lot safer to buy shares. So thank you guys so much for tuning in today, and I hope to see you guys next time.